Millions of Americans are worried they won't be able to make even the minimum payments on their credit cards. Here's what they can do. Amid one of the worst downturns in U.S. history, nearly 80% of credit card holders say they're worried they won't be able to continue making even the minimum payments on their debt. The figure comes from a survey by creditcards.com, which found millennial cardholders, 91%, are most at risk of missing payments. Meanwhile, 1 in 4 people say the pandemic has pushed them to take on more credit card debt. Most of the relief measures delivered to Americans in the first stimulus package have dried up, even as the coronavirus pandemic shows no sign of abating. The unemployment rate is still above 10%, higher than at any point during the Great Recession. More than 60% of the survey respondents said they may not be able to make their minimum payments if they can't return to work. It's tough news to hear, said Ted Rossman, an analyst at creditcards.com. Issuers have responded to the pandemic by creating programs to assist customers during this time. Julie Sherrier, senior managing editor at LendingTree. The average U.S. household has around $5,700 in credit card debt, with a minimum payment of around $133, Rossman said. Depending on your situation, you might not be able to address any of your credit cards right now. Your rent or mortgage may need to come first. If it's a house, you could lose the roof over your head, said Bruce McClary, a spokesman for the National Foundation for Credit Counseling. Still, if you don't believe you'll be able to make a minimum payment on a credit card, your first move should be to reach out to your issuer, said Julie Sherrier, senior managing editor at LendingTree. The issuer's phone number is often on the back of your card. Issuers have responded to the pandemic by creating programs to assist customers during this time, Sherrier said. However, it's up to the customer to reach out and ask for help. Apple Card is allowing certain consumers to defer payments without interest accruing, Rossman said. Other banks have their own hardship programs you can apply to. It can be helpful to explain your situation to your issuer, experts say. Maybe you've lost a job, but are looking for work or expect to start receiving unemployment benefits soon. A card issuer may allow you to pay less than your minimum payment. Whatever agreement you make, be sure to get something in writing from the bank that details the terms. If you expect your payment troubles to persist, your best bet may be to locate a financial counselor at the National Foundation of Credit Counseling.
That with David Kelly, JP Morgan Asset Management's Chief Global Strategist, and Diane Swank, Grant Thornton Chief Economist. Diane, I'll start with you. What are the bright spots in this report to you?
Well, the bright spots were the more than 500,000 restaurant and bar workers that were called back to work off of temporary unemployment during the month. What we saw was hiring in states that were reopening more than offset some of the states that had to reverse course in response to the COVID infections. We also saw a comeback in the healthcare sector outside of long-term care facilities where people actually pulled many of their loved ones out of those facilities because of the risk of infection. Elective surgeries did pick up, along with the backlog that we had to go through in terms of the delayed everything from dental appointments to doctor's appointments, and we saw a pickup in employment there. So those were the good news. The sort of mischaracterization in the data was that big jump in public sector job gains in education in the state and local level. That was a quirk in the seasonal adjustment, 300,000 jobs just due to that alone, and that'll be reversed in the month of August, especially given the number of large school districts that have decided to go back online or try to do a hybrid of online and in-person schooling. That will suppress those numbers as we move into August.
Well, perhaps some of those educators will be administering those classes from afar. But, David, you do have 4 million workers who are working part-time who don't want to work part-time. You have 7 million more people on temporary layoffs than there were in February. So how do you size up the temporary phenomenon of today's labor market from what could potentially turn into some permanent fissures?
Well, I don't think the temporary problem is going to be a problem after the pandemic is over, but the real problem here is that this sort of V-shaped recovery is basically wilting here. I mean, it is good. This is good progress to see over, 1.7 million jobs added. I wouldn't really pay much attention to consensus expectations because the truth is we didn't know how to forecast this number. There's so many distortions in the data. But the big picture is we lost 22.1 million jobs. We've gained 42% of those back. But the pace of recovery is slowing. And until we can control the pandemic, it's going to slow further. So it's really sort of a recovery interrupted here. And what we need to do, obviously, is try to dampen down this pandemic so we can adapt to a more normal situation to try to get the economy back on track. And then also we have to continue to support workers in sectors which are just shut down or mostly shut down because of this pandemic still.
Right.
I don't think we can get away from that. We can't get back to normal until we can control the pandemic.
Well, David, back to Washington then, because you kind of referenced it a bit. It's possible we will not get anything out of the Congress in terms of, I don't want to call it stimulus, but just something to sustain to what you said. What does your outlook look like if we get nothing new from Washington?
Well, I'd be very surprised to see that. I think that in the end, both sides are playing a really tough year, but nobody wants to sort of adjourn to their conventions and go into the November election having done nothing. So I think there will be an agreement. They're both just going to play it tough and then say the other side didn't do enough. So I think there'll be an agreement. But if there wasn't, it would be really devastating because the problem is that these low-wage workers have got laid off. I understand that $600 per week in additional benefits is more than they would have made on the job, but zero is a lot less than they would have made on the job. And if you take the lowest wages in America, you cut them in half and call them unemployment benefits, there's real poverty stalking the land. You can't do that. I mean, it's just going to be tremendously painful. And in addition, we're going to have more state and local government layoffs. I completely agree with Dan's characterization of the growth in education jobs at the local level. But these state and local governments cannot keep these payrolls intact unless they get further aid. So we need to do something, or this recession is going to be even more painful. I mean, you're right. It's not about stimulating. It's about sustaining the economy, supporting the people until the pandemic's over. Yeah. What you're trying to do is get through this with as little pain as possible.
Right. Diane, it's $1 trillion difference right there between the House and the Senate, or in terms of that money for the states that you were referencing earlier. But same kind of question to you. What if we just don't get anything? What will it mean for the possibility of any recovery come the fall?
I think we have a real risk of falling into a double dip, not only because we're reopening colleges and the bars are going to be opening up and congregating in colleges. That's where we've seen spread the most is among young people, and then they bring it back home again. That really is a problem. We all want to open the schools. You need to close the bars to open the schools. This is really important. So I'm very worried about after what we're set up for some kind of an increase in the third quarter, but we could slip back again easily in the fourth quarter, especially going into the holiday season. And many schools, colleges that hope to have students back on campus and through Thanksgiving may not find they can even keep them there until Halloween. I think that would be really devastating in the fourth quarter during the height of what usually are out celebrations and going out to restaurants and bars. So another hit there. Also, going on David's point, this issue of losing $18 billion a week right now because of the lapsed unemployment benefits and, the debate about what level they should be. First of all, there's no evidence that they actually deterred workers during the pandemic, which is really pretty stunning. And there's been an enormous amount of research on that. So it's more an ideology than an actual evidence. But then going further is, the kind of food insecurity and homelessness we're looking at in the weeks and months to come, even with a cut in benefits and the subsidies that we're seeing out there, is going to be quite large. We're talking about the largest food insecurity and biggest homelessness problem that we've had since the Great Depression. A third of all workers in the recent housing pulse survey by the census actually were worried about making August rent. And with the suspension and lapse in benefits, that makes it even harder. So even if they get an executive order to extend the moratorium on evictions, you're still going to have a lot more evictions out there. And this is really a humanitarian crisis that is completely avoidable if we provide support for those households. Because as David says, things will pick up once we get a vaccine, but that's an eternity from here until then for a family trying to feed their kids.
Yeah, I think everybody understands that, David. On the other hand, what do you say to the fiscal hawks who are making McConnell's job more difficult? What do you say to Fitch, who has us on negative credit watch? What do you say to people watching gold, Treasury sales, Kaplan saying that Fed support is not free? I mean, do those arguments hold any water?
Yes, but what you've got to do is there's a time for everything. This is why I was so against the big tax cut not being paid for in 2017, because when the times are good, you don't expand the deficit unnecessarily. But now times are bad. You have to run a big deficit, but you also have to commit to Fed independence and doing something about the deficit once the economy has recovered after a vaccine. It's going to be more urgent than ever that we try and get the fiscal house in order in 2022 and 2023 because of the huge run-up in red ink that we're seeing over the course of this pandemic. But there's a time and a season for everything, and this is a time for fiscal generosity. 2022 and 2023 will be a time for fiscal prudence.
Right. That doesn't sound like much fun either. Guys, very difficult debate right now, given the hardships that Diane obviously pointed to. Thanks, guys.